It's official. The rats are fleeing the sinking ship. We've already seen that the Securities Exchange Commissioner, Chairman Gary Gensler, is resigning effective January 20th of this year, 2025, as he is well aware that Donald Trump is going to fire him on his inauguration day. Now, we have just seen that fellow rat, Rostin Beanham, the chairman of the CFTC, has resigned effective January 7th of 2025. The Democrat-appointed regulators and chairmen are in fact fleeing in droves, and it makes me absolutely happy as can be. This is something that's been a long time coming, and the reason that this is so good to see is because guys like Rostin Beanham are directly tied to the very institutions that they should be regulating. For example, when Rostin Beanham became the acting chairman of the CFTC in January 21st of 2021, he was preceded by Heath Tarbert. Heath Tarbert used to be Rostin Beanham's boss up until that point, but he left to become the chief legal officer of Citadel Securities, the very same firm, or one of the very same firms, that Rostin and the CFTC are supposed to regulate, as the CFTC regulates the U.S. derivatives markets, including futures, swaps, and many kinds of options. And they're supposed to conduct basically regulating fraud in the trading of futures, swaps, and derivatives to promote integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation. But of course, none of that has really happened, right? Stock Jockey says, tamped it down. That's right. This is the same guy who tamped down the silver squeeze here in the 2020s as well. Augustine, do I think RK is coming live today at 4:20? No, I don't. But can't stop, won't stop, continues, my friend. But again, these regulators are leaving, and with good reason. We all know that Donald Trump and the administration are going to be replacing these guys. These fat cats are directly related to the very same people that they're supposed to be regulating. And there's way too much conflict of interest there. So he says, after more than 7 years at the U.S. CFTC, I'll be stepping down from my position on January 20th. My final day at the commission will be Friday, February 7th. So he goes on to say that it's been an honor to serve the people, etc., but in reality, they haven't done anything. They couldn't do anything to help with the fraud that was going on in FTX, and they have continued to do a whole bunch of nothing other than regulate the people and continue to let their best buddies and former bosses that now work at the firms that they're supposed to be regulating continue to do exactly what it is they've been doing for decades, and that is manipulate markets. But again, Heath Tarbert here is the chief legal officer of Citadel Securities since April 6, 2021. He was formerly the 14th chairman and commissioner of the CFTC. And before that, of course, he was the assistant secretary of the Treasury for the International Markets and Development as acting under secretary of the Treasury for Internal Affairs. Now, thankfully, we're seeing guys like Rostin and Gary Gensler leaving their positions effective January 20th, as they're both well aware that Donald Trump and his administration are going to be replacing them with people like Paul Atkins, who are actually going to try to regulate and who are actually going to try to help retail investors. At the same time, even this guy, Rostin, has continued to say that scams, crashes, and calamity, that there are departing Wall Street regulator here is warning of crypto risks. And there was an interview with him in which he said that further delays in comprehensive regulation means a lingering threat from a booming crypto market. This is the same guy. This article just came out today, by the way. This is the same guy that was in charge when FTX collapsed and said that we wouldn't be able to do anything about FTX whatsoever. And then FTX 2.0 is inevitable. You can see he's firing off a parting warning shot for Washington that the $3 trillion crypto market needs new guardrails fast, or else. In an interview, departing CFTC Chair Rostin said that each day without comprehensive regulation over digital assets means there's a lingering threat of financial fraud, scams, and potential calamity, including a collapse on par with the fall of FTX. He says, the fact of the matter is, in an unregulated environment, the risk of that exists without a doubt. And of course, they didn't do absolutely anything in order to create that change. They just continued to let these people at companies like FTX and their fellow subsidiaries continue to manipulate markets and create tokens backed by nothing. So President Trump, they say here, is expected to usher in a new regulatory era for crypto that will likely include lawmakers handing the CFTC more authority over the market and major tokens like Bitcoin. Yet setting up a new framework for crypto could take years. And in the meantime, the dangers may be simmering in the crypto market today, risk boiling over. He said, we've seen before in our history where we leave large swaths of finance outside of oversight and responsibility, and we have seen time and time again that it ends badly. Beverly brings up a great point, saying so many CEOs and politicians have stepped down. They still need to be held accountable. In my opinion, the SEC and DTCC are there to protect the criminals stealing our money and country. A lot of people in the comments will agree with you, Beverly. If you agree with Beverly, please drop us a note and let's see. Darren says, boss, good evening, brother, and Happy New Year to you and the family. Happy New Year to you, my friend, and all of you watching and listening right now. And of course, Beanham says a soaring market can often bring out fraudsters. He thinks that within the next 2 years, there could be a new slate of fraud and manipulation-based enforcement actions around crypto. The thing is that this guy was in charge for the last 4 years and has worked over 7 years at the CFTC and has done absolutely nothing to stop what has been going on thus far. You can see here that this isn't something new. Black Man Boating on Twitter says the SEC has written off over $10 billion. I added that in my part myself because it was over $10 billion in already low fines that they can't collect. So why would these financial criminals that illegally naked short companies stop illegally naked shorting? Owners of stocks, take note. These guys have known about this for decades. Check out what went on here in the mid 2000s around the Great Financial Crisis.
Short selling is another matter altogether. It occurs when someone sells a stock they do not own and have not borrowed. Naked short selling creates two risks in the marketplace. The seller may not be able to deliver the necessary shares on the delivery date, and bad actors can manipulate stocks downward, repeatedly selling something they do not own. Naked short selling, without first borrowing or obtaining a so-called hard locate of the shares, essentially increases the number of shares in the market, which tends to lower the value of the stock. It is exactly like if I made 3 copies of my car's title and then sold the title to 3 different people. By the time I sold my 3rd title, it would likely be impossible to deliver the car to the 3rd buyer, and its value would also have declined. When Bear Stearns and Lehman started this crumble, many believed manipulative, naked short sellers, using a series of large and frequent short sales known as bear raids, helped drive both firms into the ground. Bear Stearns stock dropped from $57 to $3 in 3 days. Let me repeat. Bear Stearns stock dropped from $57 to $3 in just 3 days. When Lehman collapsed, an astonishing 32.8 million shares in the company have been sold short and not delivered on time. The SEC has proven incapable of both preventing market manipulation from happening and punishing those who are responsible for it. Mr. President, we cannot allow this to continue. At a recent SEC roundtable, major problems with the current regulatory structure were exposed. Even the panelists heavily stacked in favor of industry admitted that compliance with the local locate requirement is widely ignored. And Commissioner Elise Walter acknowledged prosecuting naked short sellings on the reasonable belief standard is a very difficult case to bring. Because the reasonable belief standard is unenforceable, abusive short sellers are essentially free to engage in criminal activities without fearing facing criminal prosecution. Mr. President, the SEC's silence speaks volumes. They have given no indication there will ever be action. Nothing from the SEC strategic plan to various speeches by SEC executives acknowledges that this is a priority. Clearly, the cost of inaction in this area is too great to ignore. Accordingly, I urge my colleagues to join Senators Isaacson, Tester, Specter, Chambliss, and me as co-sponsors of S-605, which requires the SEC to move quickly to address naked short selling by reinstating the substance of the prior uptick rule and requiring traders to obtain a contractual hard locate before selling short. We need to send a strong message to the SEC that the United States Congress will not tolerate inaction on this critical issue.
It would shock you to believe that naked shorting is still going on today. Absolutely. Because as you may or may not have guessed, absolutely nothing has changed. There have been very few regulations in place to stop or curb naked shorting, but it continues on to this very same day. So huge shout out to Black Man Boating for posting this up there. You can go ahead and follow him on Twitter here at Black Man Boating. This good man working to share information with retail investors. But even still, it's been many decades that we've been fighting this, and it has not stopped. And it's not going to stop until we do it ourselves, ladies and gentlemen. We have to stop it ourselves, and the only way to do that is to create our own broker-dealer that doesn't route orders into wholesalers to internalize them and front-run your trades and route them through dark pools and manipulate the orders. That's why we've decided to create Lit Exchange over 39 months ago, and we have been working on it for the last 39 months, and we'll continue to work on it until we launch, hopefully here at the end of 2025. Check this out. CEO George Palikaris, former MMAT, Metamaterials CEO, said, I originally, and for the longest time, didn't believe in failures to deliver and the T plus whatever stuff, T plus 35, etc. I challenge you to find any posts I made during my time as CEO where I mentioned failures to deliver. But even when real catalysts were being announced, our stock was negatively affected. On periods of zero news, our metamaterials technology stock would run with massive volumes, sometimes over 3 to 4 times the entire float in a single day he's talking about. If you haven't done any research on our specifics, I suggest you try or kindly shut the F up. Mainly, due to this depressed stock situation along with many other factors, we lost an LBO opportunity I worked on since November of 2021 that would have added over $400 million of top-line revenue from 2023 onwards. Hey, Dougie Large. Here he's talking to the CEO of Virtue Financial, Doug Sifu. Dougie, with all due respect, I do not recommend you or anyone at Virtue's team ever speaks about MMAT, and I sincerely suggest you do your fucking research before you open your big mouth. Your team at Virtue was pitching us on your at-the-money product in 2022 and soliciting us in 2023. Do you give me permission as CEO to publicly share your ECM materials and related emails showing how you were boasting that Virtue was by far the #1 trader for MMAT? MMTLP and MMAT investors take note. George says, here is a taste of the data at the image below. I will wait for the answer. In the meantime, back in 2021, retail brokers send Virtue Financial approximately 30% of all U.S. daily retail order flow based on SEC Rule 605 data, which basically means data tracking where orders are sent to. And for those of you that are unaware, an even larger percentage goes to Citadel. So between Citadel and Virtue alone, they handle more than half of all, probably I think more than 65% of all daily trades, or more all of daily order flow of retail investors. And the only way to not allow these companies to, 1, front run your trades with their hedge funds, 2, fail to deliver, 3, internalize your trades, and 4, route your orders through dark pools, and 5, fail to deliver, 6, create synthetic shares, 7, naked short or manipulate markets. I could just keep going on. The only way to stop that is to use a broker-dealer that doesn't route to these dark pool wholesalers. And that's going to be Lit Exchange. That's why we've been working on it for so long. And you should look at it clicking the link on the side there. You can even own the company because for the first time in the history of the world, an upcoming stock brokerage is giving you the chance to own it before it launches and IPOs. This is the first time in the history of the world that any company's ever done this. Remember this in a couple of years or in a few years here when we IPO and you say, damn, I could have made a shitload of fucking money had I only invested in this company before they went public. Because we are currently using regulation crowdfunding, regulation CF, through the Jobs Act that gives you, in order to give you an opportunity through a through a FINRA approved broker-dealer and funding portal, Silicon Prairie, to own and become part owner in the company of Lit Exchange. I'll leave it at that. In the meantime, back in 2021, retail brokers send Virtue approximately 30% of all U.S. daily retail order flow. He says, my opinion is that Virtue under your leadership is becoming a monopoly by undercutting everyone else because you are selling trade data intelligence to institutions while pretending that this helps the issuers. While that is great for your business, in my opinion, Virtue is potentially breaking antitrust laws at a minimum. The Department of Justice, Philadelphia, and the new SEC leadership should take a very close look at your operations dating back at least 10 years. Your post suggests that you are part of the problem on FTDs. If you truly believe that there is nothing to worry about, ask your team to publish a white paper on letterhead using Virtue's tremendous insight and analytics around single stock and overall market trading. Given your tremendous insights, you can once and for all end the debate, and you could show everyone the inner workings of the market in a transparent manner. That will be a great service to 165 million U.S. retail investors your broker-dealer customers currently serve. I wonder if someone looked more closely at the data, would they find any correlation related to the percentage of retail brokerage daily order flow versus your annual growth in percentage market share for all U.S. retail volume that goes through your, quote, intelligent platform versus the rate of failure to delivers across the market? As you can see here, former MMAT Chief Executive Officer George Palikaris is exactly right. 31.71% of all MMAT shares traded in 2022 that, according to Bloomberg advertised volume rank here, were processed by Virtue Financial. And of course, there was massive failures to deliver on that stock amongst many others. Thank you, guys. I don't know how long I was muted for, but I was just basically saying that George Palikaris is here. I've been following him for a significant period of time, and I'm glad to see that he is actually letting it rip against guys like little Dougie Sifu here of Virtue Financial. And that being the case, there's been a significant number of failures to deliver in this stock amongst many others. And I truly believe that George Palikaris, the Chief Executive Officer of former CEO of MMAT, was a staunch advocate here of retail investors and really did a great job of trying to help retail investors in MMAT and MMTLP. Unfortunately, due to what I believe to be an alleged hostile takeover by the board of directors that were working together with market manipulators, he was voted out as the CEO and was replaced by others that wanted to make the company bankrupt. So I'm glad to see that he's really calling out here the liquidity fairy, Doug Sifu. And yeah, I do have the guy blocked. I've had the guy blocked for a significant period of time, just like many others, because I have no interest in hearing what they have to say because it's absolute dog shit garbage. Again, watching the regulators flee the sinking ship right now. First, Gary Gensler, now Rostin Beanham, and pretty soon there will be many, many more to come. So as they're calling for more scams like FTX to come through, I think we all know that these are the very same guys that could have stopped this to begin with. But the reason they didn't is because they were all best buddies with the same firms that are doing this. Former coworkers, like you can see here on my screen as well. But yeah, like you guys were saying, Bittrex, FTX, many of these other firms went out there and created tokenized securities that were backed by nothing.
Risks in the marketplace. The seller may not be able to deliver the necessary shares on the delivery date, and bad actors can manipulate stocks downward, repeatedly selling something they do not own.
This is nothing new. This has been going on for a long fucking time. And it's not going to stop until you and I stop it ourselves. Make history with us. Become owner in the first stock brokerage firm in the history of the world to route orders to lit markets, lit exchange. Of course, we are an upcoming stock brokerage firm. We are offering you the chance to own part of the company before our launch and IPO, which are planned here for later this year and the coming years as well, for launch and IPO respectively. So do it yourself because nobody's going to do it for us, ladies and gentlemen. Yeah, typo negative. Single stock ETFs. What is a single stock ETF? Nothing. It's just a single stock. A single stock exchange traded fund is simply a way to manipulate a single stock without showing the short interest on that stock. That's the reason why stocks like GameStop and AMC and Tesla have single stock ETFs of that single stock. What is that? That's nothing. That's just the stock itself. That's literal market manipulation. And they're used in order to hide the short interest on GameStop or the short interest on Tesla or the short interest on SLV, Silver ETF, etc., or AMC by creating an ETF of the single stock. It makes no fucking sense. And the reason it makes no sense is because it's just there to manipulate markets and to hide short interest and failures to deliver and so on.
Naked short selling without first borrowing or obtaining a so-called hard locate of the shares essentially increases the number of shares in the market, which tends to lower the value of the stock. It is exactly like if I made 3 copies of my car's title and then sold the title to 3 different people. By the time I sold my 3rd title, it would likely be impossible to deliver the car to the 3rd buyer, and its value would also have declined. When Bear Stearns and Lehman started to crumble, many believed manipulative, naked short sellers using a series of large and frequent short sales known as bear raids helped drive both firms into the ground. Bear Stearns stock dropped from $57 to $3 in 3 days. Let me repeat. Bear Stearns stock dropped from $57 to $3 in just 3 days. When Lehman collapsed, an astonishing 32.8 million shares in the company have been sold short and not delivered on time. The SEC has proven incapable of both preventing market manipulation from happening and punishing those who are responsible for it. Mr. President, we cannot allow this to continue. At a recent SEC roundtable, major problems with the current regulatory structure were exposed. Even the panelists heavily stacked in favor of industry admitted that compliance with the local locate requirement is widely ignored.
And that is a sham, you guys. In case you didn't know, the compliance for a broker-dealer, like, for example, Robinhood, let's use them as one example, they're to say, well, FTX told us that they had shares, and so we had reasonable belief because they told us that they had shares. We had reason to believe that we could lend these out and let them be short sold for relatively cheap. And they could then be returned to us And the shares that don't really exist, that we borrowed from FTX, that they claim to have, that they don't, we can then lend out again, get them back and lend them out again, and rehypothecate and allow the creation of synthetic shares and naked shorting and so on to be perpetuated.
Commissioner Elise
that's
Walter
legal.
acknowledged
Legal.
prosecuting naked short sellings on the reasonable belief standard is a very difficult case to bring. Because the reasonable belief standard is unenforceable, abusive short sellers are essentially free to engage in criminal activities without fearing of facing criminal prosecution. Mr. President, the SEC's silence speaks volumes. They have given no indication there will ever be action. Nothing from the SEC strategic plan to various speeches by SEC executives acknowledges that this is a priority. Clearly, the cost of inaction in this area is too great to ignore. Accordingly, I urge my colleagues to join Senators Isaacson, Tester, Specter, Chambliss, and me as co-sponsors of S-605, which requires the SEC to move quickly to address naked short selling by reinstating the substance of the prior uptick rule and requiring traders to obtain a contractual hard locate before selling short.
Now, this was in the late 2000s. And we have seen that the uptick rule doesn't do shit. The hard locate requirements haven't done shit. Everything that these guys do to try to fix naked short selling doesn't do shit. The only way that we're going to do that is by literally taking the shares away from them and routing them to lit markets ourselves, preventing them from continuing to internalize your trades. The more people that trade on Robinhood and IBKR and Webull, etc., and Charles Schwab and Fidelity and etc., when they are routing your orders to these wholesalers because they're the top bidder and they're making the most amount of money off of it, you're not getting the best spread, but the broker dealer's making the most amount of money off of it, and the wholesaler, like Citadel and Virtue, is then able to maximize their profits by front-running your trades. You're selling them to you at one price and waiting to buy them back until they maximize their profits at a lower price. Or alternatively, they can front-run your trade entirely. Alternatively, they can fail to deliver entirely. Alternatively, you're screwed either way. There's a lot of different options that can go there, and the majority of them, if not all of them, do not benefit us as the 99%. Again, Lit Exchange. Frank, and then they ended his career. That is correct, Frank Lehman. And then they ended his career. That is what happens when you try to stand up against corrupt government, corrupt politicians, and the corruption on Wall Street. We have to do it ourselves. Period. Cheers, my friends.